Pull up a tab. UK sovereign bond crisis.
Now looks to be in the midst of a financial crisis. Just the last week has seen the pound crash against the US dollar. The UK stock exchange
Sorry, when's this?
fallen sharply and investor confidence crashed.
It's not over
Amid
yet.
all of this turmoil, however, something much bigger is on the horizon. Something that very well risks a full-blown economic catastrophe: the gilt market. Now, before you turn off and watch something else, bear with us, because this may well be the start of a new politically caused economic disaster. So in this video, we'll explain just what gilts are, why recent developments in the market matter, and just why people are calling this a hidden economic crisis. So, first things first, what on earth are gilts? Well, known more commonly as government bonds, gilts are basically IOUs issued by the government.
It's like buying Canadian bonds, kind of same thing.
A piece of paper would have been printed with a set face value, known as the principal, and set coupon rates, in effect the interest paid by the government. People would then buy that bond for the set face value and receive regular coupon payments until that bond matures or expires. While the government has your money, they spend it on whatever they want: a war, a budget deficit, etc., until they have to pay the full value back when the bond matures. Regardless, the exact mechanism and technicalities of what a gilt is and how it operates aren't really key to this video or what's happening in the market. The main thing you need to know is that, normally speaking, gilts are amongst the safest assets out there. Gilts are seen as low risk, low reward, because developed economies like the UK are unlikely to default on the debt, hence the low risk, and as such, the interest rates are normally fairly low. That's why many pension funds love them and buy huge quantities of them. If you were the manager of a pension fund and you know that the employees paying into your fund will be owed £5 million in 2052, a safe bet would be to buy £5 million in bonds maturing in 2052. You'd know that you were basically guaranteed that £5 million, and in the interim, you'd get some nice coupon payments too. The last few days have messed with this model though, to such an extent that the Bank of England warned if they didn't intervene, pension funds would collapse and the economy could face some incredibly serious issues. So, what happened? Well, you might assume that the recent rise in interest rates would be good for pension funds. Higher interest rates mean higher coupon payments and more money for the funds. And yes, that is true. Higher rates do improve the position of most funds in the future. But because they're seen as low risk, low reward, many pension funds like to hedge against interest rates in a way that means that if interest rates climb, pension funds have to pay up.
Everybody, thanks for sticking around. If you're loving this content, hit the like button. Hello, right here. Subscribe and join our awesome community. Ring that notification bell so you never miss a beat. Together, we're building something special. Very, very special. Let's grow the channel and have some fun along the way, baby. Want more content? Check out these other fantastic channels. You got Checkin Habs, one-stop shop for all those things that Habs and sports we talking about. Hello. Then you got Checkin Report. Stay informed of the latest political news and current events, like our friend Donald Trump. Hello. Find out the links below in the description.
And given interest rates have climbed and climbed hard, pension funds have to find a lot of cash, i.e. sell some assets. So many assets, in fact, that, as we mentioned earlier, the Bank of England was concerned about these funds' very survival. So what's caused this? Well, on Friday morning, the Chancellor of the Exchequer, at the time of writing...
Right, so it's kind of like they short against the interest bet it to not fail.
Do they hedge against the?
They're hedging. Why you're getting fun, right?
The guys who take care of this stuff, hedging against the interest.
He takes the money and he hedges against the interest rate, and hoping that the interest rate
continues going up.
Goes up.
They have to protect themselves.